Welcome to the Bucket Plan on Demand, a podcast for financial advisors based on the best-selling book and process that simplifies financial planning. Hear from skilled industry professionals and special guests each episode that will help perfect your approach with clients and your results.
Welcome, everybody. And Bryan, good to see you. It's been a while.
Yeah, about 2 days.
And about, I think, 2 days until we see each other again in Cleveland teaching
Sounds
Bucket
about
Plan.
right.
So, well, welcome. I don't think I need to do much of an introduction for Bryan. I think most people know him, but Bryan is the president, CFO, and partner at J.L. Smith. 20 plus years of experience helping professionals, business owners, and retirees protect and grow their wealth through tax-efficient strategies. He's got a number of different designations. We don't need to go into all of them. Of course, the most important one is the BPC. Bryan's the lead trainer with me on that. We'll be teaching Bucket Plan 2.0 next week together, so looking forward to that. He's certainly a trusted industry voice. He's featured in all kinds of media outlets. And the topic today we're going to be talking about is Generation X at the crossroads, retirement realities, and tax-savvy moves. And this is a good topic for Bryan. He's been a recent contributor to several articles on Gen Xers and their retirement, particularly in Kiplinger. So, Bryan, welcome to the show. So let's jump into it. Gen X. I think Gen X, if my memory serves me right, is like mid 40s to mid to late 50s, right?
Yeah, about 45 to 60 years of age is that Gen X that we're referring to.
45 to 60. I think everyone calls it the sandwich generation, right?
Yeah, you're spot on about that, and I'm sure we'll dive into a little bit more of those details as we come along here.
What is it? Why do they call them the sandwich generation? They like sandwiches?
That's exactly right. I mean, the reality of it, they call it that sandwich generation because of where they're smashed in between two generations. And right now, if we think about it, a lot of them are dealing with their aging parents. And then they also have kids that are in school or in their college years. So they're focused over here, healthcare, long-term care, assisted living for aging parents. And then the other side of things, they have that rising or supporting children. Some of us don't like to hear this, but that boomerang kids that have come back and live in our household. I mean, Dave, I'm sure you've seen it too. A lot of the clients, 45 to 60, still have a child that maybe graduated from college or didn't put their feet down right and is living with mom and dad.
I feel like that's my wife's dream, that our kids never leave and they live with her forever. So I don't know. That's not a bad thing for some parents, I think. Maybe when they're like not 9, 7, and 3, she might change her mind, but we'll see. So they're living in some of the consequences right now. And I think, the reality, Bryan, as you well know, consequences motivate people to take action and start doing some of their own planning. And I think that's really relevant for this generation. Bryan, give me like a little bit of backdrop. I mean, at JL Smith, how much of the client base and the opportunities that you run into are Gen Xers versus, I know your core business over the decades have kind of been built in more of the boomer market, but, are you starting to get in front of these people, and how are you doing so?
Yeah, so I would tell you previously, maybe 5+ years ago, it was 85% in the boomer market. But as people age and that generation of Gen X is getting closer to retirement, I mean, especially the people 55 to 65 years of age, which is that first beginning end of the Gen Xers, we're seeing a lot more of those. I would tell you it's probably more of a 60-40 ratio. We're seeing more and more where the 40% is being these Gen Xers. So, I mean, the reality of it, Dave, is this is the way of the future, and this is for all of us on the call of the people we need to start focusing on. I mean, where we do our best work is essentially that 62 to 65 years of age, catching them right before retirement and implementing financial plans for them and putting those things into place. So this is really our target demographic as we're speaking right now.
Yeah, I think, if I know Matt's on here, Matt Seitz, but like, these are probably the highest lifetime value clients in the firm right now because they have enough assets and income to, to make it, to warrant like the time we spend with them. They're profitable clients, but, to Bryan's point, they probably have another 5 or 10 years of accumulation of adding more money to their accounts, continuing to build wealth. And then, they've got probably, 30 to 40-year life expectancies that we're going to need to support them for. So this is a huge area. I know, like, if I look at Allison Wealth Management, I would say about 75% of our assets under management fall in this range of a 45-year-old to a 55-year-old. They're in the height of their career, their earnings potential, they've got complexity. They know, that retirement isn't like terribly far off. They've built a nice nest egg. Maybe they're executives, they have equity, they have stock options, they're paying a lot in taxes. And to Bryan's point, they've got kind of challenges on both sides of it. So I think, messaging and opportunity is huge for these people. So Bryan, let's, I guess, kind of jump into some of the things that you're talking about that maybe is resonating, whether it's marketing and getting in front of these people, or once they come into the office. And I guess just from a marketing perspective, again, like, I'm a lot smaller scale than you guys are at JL Smith, but I find this to be the number one source of referrals for me. I find that, that client 45 to 55 or 60 is a lot, more prone to refer their friends, their colleagues, other people they know in similar situations. I haven't had as much success in like the referrals in like the, the 65, 70, 75-year-old space. Like those people kind of already have a lot of the plan, the foundation, but these Gen Xers, they talk to each other and they have a lot of, similar challenges and concerns. So how are you getting in front of them? And then, what are some of the concerns, the things that they're hesitant on, and the challenges that you're solving for them?
Yeah, so I looked at our referrals, and I've been averaging maybe about 3 a month, roughly, in the business. 8 out of the last 10 have fallen into this category of being Gen Xers. So to validate your point, Dave, you're pretty spot on. Is like the majority of the referrals I'm getting now are right in that ballpark of things. And they need help, because if we go back in time and we say, hey, 45 years ago, that was 1980, and then we say 60, 65 or 60-ish years ago or so, somewhere in that ballpark of Gen Xers, we do some math there, that's like 1960s to 1980s. You got to remember what happened to these individuals in the year of 2000, 2008. I think psychology plays a huge role into marketing to these individuals. Some of these people that are 45 years of age or 50 years of age, their first investing that they ran into is tech bubble, boom, and then also 2008 global financial crisis. So I see a lot of these people being jaded somewhat on investing. Now, it's not all of them, but just be aware of what they've lived through of 2008 to 2010 being a terrible market, and the worst market pretty much close to we've ever seen. So with that being said, that's important. They've also had the global financial crisis of job changes and then also COVID. So you can see the disruption during their prime saving years, having to jump from jobs. Like these kind of topics are super important, and it relates to them. So I always love to bring that stuff up to them. But also, we got to think about bigger mortgages. If you look at the underlying data here, Gen X spends about, on average, about $83K annually, where their parents, the baby boomers, spent $62K annually. That is a substantial increase, almost a 33% increase in expenses that two generations are facing. So what I've learned is a lot of our baby boomers have been more World War II, learned to save, eat out of cans, all that good stuff. And then you have this next generation where the baby boomers made it great for the Gen Xers, where, they like to experience life a little bit more. So that is important when you're talking about things. Is a lot of what I've seen, and Dave, I don't know if you've seen it too, but these people like to spend money. They like to enjoy money a lot differently than the baby boomers. Experiences to them have been crucial. I'm sure, Dave, probably you've ran into some of that. Would you say so?
Yeah, absolutely. I mean, this is, again, like, I even look now, I'm not a Gen Xer. I'm an elder millennial. I'm kind of obviously on that end. But I think, like, the thing I always share, you can't really see this Die with Zero book. Like, this is the stuff that resonates with them, right? Like they've maybe even experienced where, their parents have saved, accumulated, and they're kind of afraid to spend their money. They live that what if retirement that we talk about. And, they don't want to be in that same trap. So, I've seen that absolutely. They definitely want to go out there. They want to spend. They want to enjoy. I've also seen I think it's what bucket of Gen Xer you're working with from a demographic standpoint. I get the fortune of working with, a lot of highly educated and high net worth, sophisticated Gen Xers. And I will tell you, they have such a resiliency to markets that I've seen. They're actually on the other side of the spectrum where they almost have no ability to sense what risk really is. They've the last 20 years of their life, they've lived through one of the most prosperous stock markets that I think we've ever seen. Maybe not the top one, but top 3 or 4. And so making money in the market, they see it as volatile, they get it, but most of the volatility that they've experienced has been a V-shaped recovery. I mean, think about the more recent few years. A lot of them didn't actually have financial assets and wherewithal to live through the giant downturn of the great financial crisis. They were actually somewhat benefactors of that because they were dollar cost averaging and earning. And so I actually think there's a big psychological component into why we're seeing V-shaped recoveries in the stock market right now. And it's Americans as a whole, the people who are saving, contributing, and investing, they are just so programmed to buy the dip, and they're deploying capital and they just they don't see the market as risky, which is kind of challenging because then you try to educate them on things like sequence of returns risk or having to sell in a down market. And they have this mentality, well, yeah, but it's always going to come back. Well, yeah, it will, but not if you need to take money out and you need to start thinking of how to prepare for these things. And so I've seen their just association with risk is a bit disconnected, where I don't see that with my baby boomer or senior clients. They understand risk, they understand volatility, and maybe they're a little more on the conservative side. Bryan, what are you seeing?
Yeah, I mean, it's a little bit across the board. I know the demographic you work with is a lot, higher net worth, where I'm seeing people at JL Smith, we accept people $1 million plus. So I would tell you it's definitely both of those. I want to give a great example here so I can talk real life scenarios with you. I'm going to speak to a referral who I am going to hopefully close here this evening. Referred to me from another, actually a baby boomer generation, but worked with this individual. The wife got on the call and she goes, I need you to solve one problem for me. My daughter will be going to college next year and we want to pay for it. How do we fund this most tax efficiently? And then 2 years from now, my next daughter will be going to college. So I'll have 2 kids in college for 2 years. And how, if they go out of state, which they were planning on going out of state, how do I fund this? And we were right into the next meeting. I said, I heard what you said, Jen. I am going to create a strategy for you and I'll have it ready for the next meeting. I mean, that really won her over. And now they're looking at, hey, moving assets over and doing all that great stuff. So I want to share that out with you. Is college funding has been a big one. I want to give you a few more to everyone in the audience to relate to these people. I mean, Stoyan kind of said it in the chat. They're probably seeing their parents age, going to assisted living or something like that. Is how do they start funding for long-term care? Right? How do they put a life insurance, long-term care combo in place? Because a lot of them have seen what their family is gone through. If you look at the fact finder that we have at C2P, there's a specific question. Have you ever had anyone go into a long-term care situation? That was brought because of having these conversations. The one other things is, I get a lot of this, Dave, and I don't know if you run into this, is they still have a lot of these people still have some sort of a mortgage, right? And they always ask me, should I pay that off before the time I retire, or should I max out my retirement contributions? And when we say max out, it's not just that $30,000 they can do after the age of 50. It's running those what if scenarios based off of, should I pay off the mortgage quicker? Is that going to hurt me more in retirement? So I want to tell you guys in your CRMs a few different things. If you know someone has a mortgage and they're in this generation and interest rates go down, you should have something that's flagging you to reach out to them. Like that is super crucial. And the next thing is when they turn 50 years of age. Remember, we're talking 45 to 60. When these people have their birthday of 50 years of age, you should be reaching out because guess what? Their 401k contributions can go from $23,000 to $30,000. So what we've done is we've put these alerts in our CRM to make sure we're reaching out to these people and staying in front of them because some of these, Dave, as we're talking about, is you can't get some of those assets to 59 and a half. Now, there's some liquidity in other areas, but 401ks and stuff, we got to wait to that in-service withdrawal. This is how we stay in front of these people.
That's great. What are you doing? I mean, I want to touch on two things. I want to talk about, kind of going back to that sandwich generation, but then I also want to talk about some kind of tax savvy, strategies for these folks. So, we've got these clients that are in this sandwich generation. Are you doing anything to go upstream to the parents and help them solve some of those concerns that they might have of like, what if mom and dad does need care?
100%. Sometimes you run into situations where it's beyond what we can help with, but we have a legal team local that we refer to these situations like mom and dad are on the doorsteps of going into the full-blown nursing home. That's where you need the legal team into place, but you were a part of it. In addition is I can't tell you probably 3 to 5 clients we took on in the last rolling 12 months of parents of these people, this Gen Xers that were already clients, because they had a financial advisor out there, not in tune to exactly what's going on, and be able to help them with their assets. So that has paid dividends. I always tell everyone we're a third generation firm. I used it again last night because mom, who just passed away, was like 87 years of age. Now we're working with the son who's 60 and the wife's 58, and they want to make sure their kids are protected. So having that conversation about legacy planning and helping them along the way here. I think, Dave, we can go into some of those tax strategies that I want to share with people.
Hey, Bryan,
Dave,
before we do that, I just want to touch on too, like, because some of these clients you're going to run into are they do have significant incomes. I've seen a good amount of success when I'm meeting with these clients and I'm asking them, the connection questionnaire has the question about parents, are your parents still alive? What are their ages? If they're obviously deceased, when did they pass away? And then there's the question of like, do you anticipate caring for anyone now or in the future? And, I'll always have a little bit of an open dialogue with the clients at that point saying like, do you have brothers and sisters? And, they'll tell me what their family dynamic is. And I'll say, okay, if something happens to mom and dad, are they financially sound enough where they're going to be able to pay for all of the care that they need, whether that's in-home nursing care, and then as they kind of, continue to transcend into potentially, nursing home, assisted living, all of those things, like, do they have enough money that they're fully taken care of? And, that one of you is not going to have to be their caretaker. You're going to be more in that role of care supervisor. And you typically find out, it's always one of two things. Well, I'd say it's one of three things. Number one is they really don't know what mom and dad has. And I will talk to them about, okay, maybe it's time you guys have a family meeting to put a plan in place around what their care would be, because at the end of the day, you don't want to, wait till it's too late and they have dementia and you guys can't think through the right situations together. So have an open dialogue, number one. Number two is the clients will say, no, we're going to have to help mom and dad. We're either going to have to be caretakers or our brother or our sister will, or we're going to have to help them financially, right? And we all know like that creates rifts in families, especially if maybe somebody's helping financially, but then somebody else is doing the actual caretaking and one side doesn't feel the other side's pulling the weight. And so I think that's an opportunity where I share with them, and I always use this language, like, let me share with you a couple things we've done with other families that maybe your family would be interested in. John and Sally, you told me that if Sally's mom and dad were to need home health care or nursing care, you two are probably going to be the ones that are going to contribute financially to that care. What if we looked at starting to set something up that provides more tax efficient benefits for them for a fraction of the cost of what that future care will be? And if they never need it, you get that money back tax free as an inheritance. But if they do, now we've leveraged for potentially quarters on the dollar what that out of pocket cost of care would be. And of course, what I'm talking about there is something we teach in tax management journey, right? Having your high income clients that have discretionary cash flow gift some assets up to mom and dad to buy a life insurance and long-term care policy on them. So like I always share that context of like, let me just share something we've done with other families. You might be interested, you might not be interested, right? So I think that's one area where if they say like mom and dad don't have the money, well, the family does, and they're going to have to come up with the money unless they're going to let mom and dad go on Medicaid and go into some, nursing home that maybe they don't get the proper care that they desire. And then the other side is if they say, oh, I know mom and dad's got that figured out. They have the assets, they have the resources. Well, now I might have a referral I want to get in front of also. Maybe I need to make mom and dad a client too and talk about how we connect multi-generational wealth transfer to make sure that the assets mom and dad have are maximized, not just for their entire life, but then from an inheritance perspective. And so like that conversation opens up the door to a lot of things. And I just wanted to share that with this sandwich generation. It's a huge opportunity.
No, I love it, Dave. And with that sandwich generation, I think we got to think about, you talked about parents, but I'm going to talk about the kids again. And one of the tax strategies, and it doesn't save a whole lot of money, but it's one of the things I introduced to that client I spoke about before. And I'm sure, Dave, you've probably heard about it, and I just want to share with everyone is super funding the 529 plan. What you can actually do, we know the gift and what we can gift each year per individual, per person you're giving it to. But the reality of it is they allow you to put about $90,000 into a 529 plan in 1 year. And you go, well, that's above the gift tax. You're right. You do need to file the IRS Form 709 with this, but you can elect what they call a 5-year election, meaning we're splitting that over 5 years. So we can rush all that money into a 529 plan in 1 year. And then we have the ability to file that 709. And as long as you don't exceed the limits of a per year over 5-year maximum that you can contribute, and we have the ability where it doesn't work against your estate exemption. So there's a way to super fund these 529 plans that's not really brought up. So I want to share that with each and every one of you. Another case that I was working on where the husband was a baby boomer and the wife was a Gen Xer, about a 5-year age difference there, is we did a donor advised fund. He had a lot of money in NVIDIA stock, so we took $250,000 last year, knowing he was going to retire this year and she's going to continue to work. He was an executive of a medical company. She works at CVS. Income's about $700,000 a year. But if we gave $250,000 of that donor advised fund, we were able to take the majority of that, or there's slightly of a carryover because that's limited to $30,000 of a deduction for them. So these are kind of the strategies that I have brought up. Obviously, your traditional Roth conversions. I know, Dave, we can get into some of the more multi-generational stuff. I don't know if we want to go that deep today, but just talking about them, hey, catch up, $30,000 contribution. And then mega backdoor Roth conversions if the 401k is allowed, or backdoor Roth IRA conversions. That's a lot of how I've built up this clientele. I've had a client on the books. They're right here, about 55 years of age. They're coming in tomorrow to do a long-term life insurance policy on the wife. But what did I do over the years? All I did was backdoor Roth conversions for them because I couldn't get any of the assets. He moved jobs. I was able to get the 401k. But this is how you stay in front of the people and have these different kind of strategies.
Well, and I'll touch on a couple in the closing thoughts that we have, just because, again, I mentioned probably 75 to 80% of my assets are these clients. The SMAs that we have, Orion Custom Indexing or Dimensional SMA, is a game changer for these clients because At this point in their life, they should have the wherewithal to have excess savings, right? They should have a good enough income. They've probably paid off some of their credit cards and debts. They should be living within their means, and they should be able to continue to dollar cost average. Those post-tax SMAs, once they've already maxed out the Roths and the backdoor Roths and the 401k and all that stuff, if you think about the order of savings, they are prime candidates for these, and the tax efficiencies are incredible. I was just reviewing 2 clients of mine yesterday with an advisor. One of them has been dollar cost averaging pretty significantly into their dimensional SMA. Year to date, they're capturing the full stock market performance from an equity portfolio, but we have realized $1.4 million of capital losses to be able to use to offset other areas of their portfolio. Now, that's a large client adding a lot of money, but I reverse engineered the numbers, and it's about 5% of their market value of the portfolio is what's been generated in losses to be able to use to create tax deductions and saving elsewhere. It's about a $34 million portfolio, 1.4 million of losses year to date. Like, that's a big deal. Then I looked at the flip side of even a client who's not adding anymore. I looked at a dimensional SMA we set up. They haven't added a single dollar of money back in, but because we're having dividends and interest paid to cash, and then we're using that to set a new basis by buying new stocks and using that for tax harvesting, they will have a $45,000 tax deduction this year through the tax loss harvesting. This is about a $1.3 million portfolio. So about a $45,000 tax loss. And that portfolio will have about $28,000 to $30,000 of dividend income because of the stocks that it owns. And so for a client like that, they're high income earning, they're in the 37% federal tax bracket, they're in their peak earning years. We don't want any unnecessary portfolio income hitting their tax return because the government's going to take 23.8% of it, plus this client's in Ohio, which I think is like 4 or 5%. So like 30% of 30 grand is going to the government. That's about $9,000 of avoidable and unnecessary taxes. But because we have the SMA working in the background, we washed all that tax liability out. So that's huge, thinking about clients that have the capacity to continue to add money, dollar cost averaging, Orion custom indexing, dimensional SMA, those portfolios are huge. The other thing that's huge for clients is like they get to the point where they might be able to start funding a side hustle and a side business. We've done this with so many clients to capture deductions. One big, beautiful bill added some unbelievable tax benefits for business owners. I think we all know that. A bonus depreciation is back. Section 179 depreciation is back. If I could take a high income earner, we had a client, for example, husband and wife, both high income earners, but the husband's kind of got a cushy job. He's got a lot of excess time on his hands. We had him set up a separate business. He's doing equipment leasing now. He bought some of those big industrial equipment pieces and he's leasing and renting them out, kind of like Uber, right? Or Airbnb for industrial equipment. We were able to get $1 million bonus depreciation to be able to offset a lot of their W-2 income because he's meeting material participation testing in that type of business. And so like there's just moving parts that you can think of for these high income clients. Again, a lot of the stuff we teach in TMJ that is, different and differentiates you, especially as you run into higher income, higher net worth ones. And so just so many opportunities with these people that have a lot of income and a lot of opportunity. Bryan, any closing thoughts?
No, I would just, last thing is just saying this is the wave of the future. This is our future client base. If you're not already dealing it, Dave, it's a majority of your clients. It's becoming more and more every day, the majority of my clients. And like you said, there's a lot of longevity here with these clients.
Awesome. Thanks, everybody. We'll see you next week.
Thanks for tuning in to the Bucket Plan on Demand, brought to you by C2P, an organization whose purpose is to educate, train, grow, and support holistic financial advisors so families can achieve true prosperity. Subscribe today for the latest episodes and insights. Visit c2penterprises.com to learn how we can help support and enhance your advisory business. At the time of delivery and any subsequent publishing, information was deemed reliable but is subject to change by the time of listening or viewing. The contents of this piece include options and projections of C2P, are subject to change, and are for informational purposes only. The information provided in this presentation is not intended to be individual investment, tax, or legal advice.